My name is Joey Tamer. We have a great panel. I will let them introduce themselves, and then I'll tell you something about me. Todd, you're up first.
My name is Todd Davis, one of the co-founders of Spark Capital. We've been in existence now coming up on a year and a half, $260 million fund focused where media, entertainment, and technology come together. Average deal size around 12 to 14 million. We've done 11 deals so far, had one early liquidity event, and that's all I'll say for now.
Roland.
I'm Roland Vandermeer from Cobb Ventures. We are a venture firm specializing in communications, which is everything that's hip and cool today, as well as all the stuff that it runs on. We have about $1.5 billion under management, and there are 6 partners and a business development and recruiting organization as well.
I'm George Zachary with Charles River. I've been in the venture business since 1995. In the late 80s, I joined a guy named Jaron Lanier, and we started a company called BPL Research, where we coined the term virtual reality. I then went to Silicon Graphics and led the development of the Nintendo 64 there. Then I got in the venture business in 1995. I'm also the co-founder of Shutterfly, which is one of the leading digital print companies, which just went public about 3 weeks ago. And we are focused in on seed and Series A investments. And I also co-founded a movie company down here, actually, with one of my best friends, who's the co-founder of eBay, which went on to go, we actually went on to produce Syriana, Good Night, Good Luck, and North Country. So I'm focused in on seed and Series A investments, and we're managing about $250 million in the current fund.
Hi, I'm Sunjane Young. I'm a managing director with Oppenheimer & Company, which is an investment bank. I head up the digital media and internet investment banking practice, and actually just joined them about 6 weeks ago. I've been in investment banking for over 14 years, covering technology, media, and digital media and internet. And Oppenheimer provides a wide variety of investment banking services, including private placements, mergers and acquisitions work, as well as IPOs and secondary offerings.
Mike?
And my name is Mike Buckley. I work in Intel Capital, which is Intel's corporation's strategic investment arm. We are one of the largest strategic investors in the world, with people on the ground really all over Europe, Asia, and the US. And my investment focus is digital home, digital media, and consumer internet.
David.
And I'm Dave Higley, and I got a little lost, but I'm a managing director at UBS Investment Bank. I split my time between LA and San Francisco. UBS is a global investment bank. I've been at UBS for 7 years. Clients include, e-marketing would be like a Quantive, mobile would be iPhone and Jamdat. Video games would be Activision, THQ, Midway Games, Lionhead, games in that sector, but again, focused very much on the content side.
Good. We're going to skip around in the outline of the script I sent you, and probably throw it away altogether. Let's start with what are the hottest spaces you're seeing in terms of investment? We have more investors on the panel than we have in the previous times. So step up. Let's start with Roland. What are you seeing as the hottest space that you like to invest in? You can have multiple choice if you want.
Well, by definition, in early stage investment, if it's hot, it's too late. So we're not investing in the hottest space, so we're seeing a lot of flows. Everybody trying to copy a YouTube-like scenario, any kind of social network around any kind of content is being thrown around, all the venture firms, I think, right now. It's not very exciting because it's not different enough to make it a change. So I think there's going to be much more emphasis, I think, in ours, looking at how to monetize and get paid for what you do, even in the internet, even in all this free world, but how do you actually get the value out of it? And that's not advertised support necessarily. So we're tending to look at real service offerings that you can actually collect money for the value you're delivering. And I'm being that vague,
That's not vague. I think having a business model might be really useful for an early stage investment. So we're not repeating the early years of the century when everyone got silly, right?
Well, it's going on right now.
It's silly. It's looking silly. It is. Okay. George, you got some ideas?
Yeah, I would concur with that. My take is, I mean, I never tell people we're going to invest in, because it would be like Apple announcing what products they're going to build as they're developing them. It doesn't make sense. I can't answer that question.
No, it's spaces, general spaces.
I guess the best way to put it
segments.
is things, I won't say directly, but on the consumer net front, things that have very low customer acquisition costs and high switching costs. That's something we look at in every deal. So I can tell you what it's not.
Okay.
Flat content where you're just putting up a website that might be focused around a demographic, to me, is something that has very high acquisition costs and is very easy to copy. So anything that's got a core of interactivity and community can be part of that, which keeps the user's attention on the site and paying a monthly bill is something that I like.
Not just content,
Not just content, yeah. Content
services,
is
tools. Infrastructure, you
Yeah,
doing any
yeah.
infrastructure deals?
We are. I am not particularly, but the rest of my partners are.
Okay.
I think we're going to see an entire new wave of infrastructure that's necessary to drive this existing bunch of content. I mean, to give you a statistic, YouTube, the amount of video on the net is chewing up about 300 gigabytes a second of video. And if you wanted to take the entire TV infrastructure and enable that, you need about 300,000 to 400,000 gigabytes per second. So you're talking about $100 billion to $200 billion investment to transform the infrastructure to do that. So we don't think video on the internet is going to, within a year, is going to basically invert and kill all of the major media. We see a long-term path to doing that. It's just going to be expensive to get there.
Well, we never see it die. All
Yeah.
those media continue.
That's right.
Their media never die. They just keep going and reinventing themselves and adding appendages.
But I would say we're definitely, I wouldn't say things are bubbly, but I would say things are bubbly, but not a bubble. The issue is what the liquidity is. And relative to 1999, when we had lots of companies getting lots of liquidity, and individuals were left holding the bag in the public market, a lot of the individuals left holding the bag could be us on this panel. So,
No more, never again. Todd? Give us some specifics, Todd. Specifics.
We like to invest in hot people, not hot markets.
Okay.
I think that may sound kind of glib, but we look for very gifted people who have a history of success who are going after what will be a hot market somewhere down the road. You take a gamble on whether that's a hot market. I think there's still plenty of room in how we're going to monetize all this content now. You've got an $80 billion TV market that's radically shifting to other media, and nobody's really figured out a real good way to monetize that yet. So there's a huge opportunity there. I also think there's a big opportunity in content that's purpose-built for this new paradigm of mobile and broadband, just taking TV content and throwing that online, or taking videos of people getting thrown down the stairs in a shopping cart. That's not exactly what I'm talking about. I'm talking about new brands built for broadband that have an interactive component, which broadband will allow. And we've yet to see that really exercised to the extent that it will be.
And you want that in a niche market, or multiple niches, or
Like,
broad?
the beauty is, you could invest in a magazine rack because the barriers are so low to developing the technology and to distributing the technology. I mean, I could come up tomorrow with a piece of content that literally has distribution into 350 million homes. I don't have to go to Comcast to try to get into 12 million homes. I get into 350 million. The only question is, how do people know I'm there? That's going to be a huge challenge, and that's a huge opportunity.
Good. I'm going to jump to Mike. Mike, what's your company doing?
What's that?
What are you doing?
Well, we have a pretty big investment team. So we have a good sized number of people looking around the digital home and consumer internet areas for kind of unique business plans. I mean, I really have to agree though with the comment around investing in people, because this is a rapidly evolving, changing area. This media is becoming mobile, and there's communities evolving, and there's stickiness associated with that. People are willing to pay for more targeted, more quality content. And as this is all just changing rapidly and evolving, good people have good knack for finding those good niches and then when they seem to evaporate or the market evolves away from that, then they can move quickly, and that's where you want your money, is where they perceive it and find the next opportunity to morph into. And so that is really a key focus, and so I strongly agree with that. But from an investment area, I mean, I'm still excited about this space. I think there's a lot of interesting things happening around enabling the business models, and getting advertising more targeted and available to mobile platforms. And there's then also I'm pretty interested in a lot of the social aspects that creates community and therefore stickiness among customers.
Okay. Now, when you're talking about investing in people, you're meaning entrepreneurs who've done it before? Is that a criteria? Have done it once or twice before?
For me, it's a good proof point that they're good and they know how to do it. It's not necessarily it's not a requirement. I mean, I think there's always those guys all had their first time, and so it's sort of being able to evaluate those anybody, whether they've had some previous successes, failures, or no experience, and just trying to gauge how good they are. And how good their supporting cast is. And there's lots of different ways you can measure that. Sometimes it's who they surround themselves with, because they had to convince those other good people that find them, and they convinced them that it was a good idea. So there's lots of different sort of tests you can do. It's a little more qualitative than that, but tests that you can do to measure that, in addition to having previous successes.
Okay. David's nodding. David, what are you seeing?
Well, I think it's a good time to be an issuer right now. And I mean, we've seen this conference. I don't think it's ever been bigger than it is right now. I mean, everything goes in cycles, and there was a time when it was impossible to raise money. I think there's a lot of capital in the market. Certainly at UBS, we're typically an agent. We're not putting money to work. We have a fund, but it's not affiliated with us. But you are seeing a phenomenon with the hedge funds, about $100 billion of private equity, broadly defined, and a lot of that's flowing down to venture is going into the markets. And just there's a lot of money in the system right now, which makes it harder for all the guys here on the panel, because you can find a great deal, but then it's not just the deal, it's the price and everything else. And there's just a lot of competition around that. But back to one thing we see as an agent is you really see kind of two types of investors, and I don't know if there's necessarily a right one, but people tend to fall into either betting on the jockey or the racehorse. And there are some that have success in both models, and I think the ones that are, I tend to be more of a bet on the jockey kind of guy. But I think there are clearly some interesting business models that people have invested in. Sometimes they change management, they've done some things that have grown up to be big companies. And conversely, there's been some great managers that have taken something really great to kind of see through.
Son, what's going on in Oppenheimer?
I just add a couple of observations to what people have said here about interesting spaces these days. When you talk about the infrastructure and applications that are going to be needed to really handle all of the video that's being consumed over the internet and other forums, I think there's some really interesting applications or companies that are starting around video search. And if you go to the major portals today, the search experience is not necessarily that great. I think Truvio, which AOL bought, is a good example of how a startup was able to come out with a better mousetrap and provide a better search experience. But there are also interesting companies that are just getting off the ground, let's say like a Clip Syndicate, that are basically aggregating different types of video clips and then acting as somewhat of a middleman to distribute it out to different websites and publishers to allow people to more easily find the video content that they want. And that's something that I think generally is somewhat lacking today. Then the other really interesting area where I think there's a bunch of young companies has to do with different ways of handling advertising. So whether it's through starting ad auctions, which are a topic that a lot of people are talking about, ad auctions as it relates to buying and selling radio ads and cable TV ads as two examples, or just ways to enhance and target current advertising in cable in other traditional forums. That's an interesting area that could be big in the future.
Thanks. Well, in my work dealing with the entrepreneurs who come to you to look for money and helping them build their companies, when we get to capital strategies, which is where we start with the exit strategy. You know, what are you building this company for, and what do you mean to do with it, and how long will it take? So it's helpful for the audience to know, what are you looking for? In your exit, are you looking for selling to a strategic buyer? Is the IPO market still a little off because nobody wants to pay the price to do the IPOs anymore? Or are you looking for the big wins? Who wants to go? Roland?
So I think it's a really bad question.
It's a question nobody ever wants to answer.
Because frankly, if you're not building a real business, don't even bother. Okay. And you got in today's world. I don't care what the IPO market is doing, what the M&A market. If you can build a company with revenue and profitability, you're creating value in the long term and growth. The rest of it will take care of itself. And that's a thesis you have to work in today's environment. Right now, the window's open for some unknown reason, and there's a bunch of things popping out. Don't think it stands up very long, but it is
The
open.
window for,
IPO window.
yeah.
I don't know why it's sustainable. I
Yeah,
can't fathom that. And the M&A market is pretty lame, except for one exception just recently. Okay, so why even contemplate that in your thoughts? If you're not doing this because you want to build a business, don't. That's rule number one. And then you create some real value, okay, by building a real business. And if you think that way and you really want to do it for the right reasons, everything takes care of itself.
It's just one of my first questions to the clients.
We have
That's all.
$100 million companies that aren't public, and we have $120 million companies, we have $80 million. We're not taking them public because the window is the window, but we know there's value there. We're building profitable companies, and that's what we'll sit on until it's right.
Absolutely.
Now, also, we do have to find an exit for our investors, but
Yeah, you do.
can't control that.
You do. No, I always want to know from the entrepreneur before I work with them, if they're trying to flip a business, then it's a different strategy, and they probably aren't going to win that strategy in this environment. In this capital environment, that's not what's going to work. Some of them never want to sell their business. Then you have to build value in a different way and take your capital in a different way.
Yeah.
Son?
I would just say, from the non-venture capitalist perspective, what I'm seeing as an investment banker, and I think Dave may be seeing some of the same trends, is that there's a relatively robust M&A market if you want to sell a young company for, let's say, up to $75 million or something like that. Because there's a fair number of strategic buyers who need to fill holes, or they feel that they're missing something in a product line, or they need to really get into the digital media space, so they'll spend that. And then there's enough exceptions out there, whether it's like a YouTube or a Massive or MySpace, where the valuations have been pretty high for these deals relative to the level of revenue generation for that company. And I think that tends, for some people, to distort entrepreneurs and certain investors' expectations of what their businesses can achieve.
George, you tried to say something?
Yeah, there is something a little bit different that we actually haven't addressed. And right now, there are a group of people who are purpose-driven entrepreneurs that aren't doing this for liquidity. They're doing it to create, their position in the community and also live off of their business. I mean, there's two very good examples. The guy who started Wikipedia, and the number one is Craig Newmark, who started Craigslist. Craig has zero desire to take the company public or sell it, but in the process is driving all the major online properties nuts because he's basically creating a blocking entity in basically local advertising. And I think there's going to be an increasing amount of people that are like Craig Newmark, that are doing things because they think it's cool and they make enough money doing it that they're happy with their lives.
This is a distinct change from
This is a distinct change, yes.
6 years ago. This
Yeah.
is a new trend. Now, are these examples you're seeing, I mean, not just those two, but the others, are these older entrepreneurs who've done it before, and they're settling down in their middle age? Who are they?
I don't, there's not enough data points yet to say who they are.
Okay.
But clearly, it's someone whose personality is probably dissimilar from Donald Trump's.
What a blessing. Todd, you have something to say? Elvie?
those are typically people who have been molested by a venture capitalist or something.
That's what I thought. Yes, they've been there before, somebody hurt them, and they're not going to do it again. I see a lot of that.
You fool me once, shame on you. I think that unfortunately the venture capital model is systematically inclined to invest in companies that can be liquid in 3 to 5 years. And it's not a cash flow business, it's not a business where you pay dividends. Unfortunately, our current tax situation, current situation with Sarbanes-Oxley, and current situation with the constipation of the financial markets leads you to the point where it would be nice to actually build companies without having to take them public. I think the way you build a company is you build it as if it's a cloudy day. And you keep building it, not assuming there's going to be a big liquidity event, there's not going to be frothy public markets, there's not going to be frothy private markets, but then when the sun comes out, sell the company, take it public. Raise money at a stupid price from somebody who has stupid money, and but build the company, as Roland said, build the company as if it's a cloudy day.
The only thing I would add is, historically, and this does get back to, and I've said it was, the proverbial sex, drugs, and rock and roll in the industry was the IPO. And a lot of times, 8, 10 years ago, even earlier, a lot of the strongest companies went public, and that was an exit. It was a way for management, it was a strong management team that weren't ready to sell. I think what we're seeing now in the M&A market is a lot of the stronger companies, and this does have a little bit of an impact, with Sarbanes-Oxley and some of the costs, but I think also just the prize really isn't the IPO in the same way as it used to be. And I think some of the luster went off of that. I think there's risks associated with being public, the liquidity and the volatility of the stock and everything else. So you're still, historically, about 95% of all exits on the venture side are M&A. But I think the difference is, it used to be kind of the top 5%, and there's a lot of exceptions around it, but the top 5% were the ones that were percolated the IPO market, and I think a lot of that's changed. What we've seen, dual path IPO is the norm now. Same thing as joint book runners, that's another thing, but dual path IPO is the norm, and we've had multiple. IGN was a deal, it was a dual path. Rent.com was a dual path. Those were companies that were profitable, could easily have gone public, but the price was right, and in this M&A market, they went public. They were sold.
I think I found it with my clients I've been doing this for 25 years. During the boom of the turn of the century, early century, ours, the pressure came from the investors. The pressures came from the investors to create the exit, to demand an exit, to know what the exit was going to be before they would invest. If what you're telling me is that the entrepreneur has changed and the investing climate at early stage, which is what we're talking about, your early stage investment criteria is different, then that's a whole new trend as well. I mean, I know you need to get liquidity for the investors after you do Series A and B, right? No.
No, I think
Tell me.
You're saying things that might be in some popular press, but frankly, smart investors are building companies, okay? What's your exit vehicle is about the dumbest question you can ever ask an entrepreneur.
You said that twice, thank you.
And therefore, these guys don't ask it, I guarantee it. Unless they say, this is a little small company, what are you going to do? I'm not interested in investing. That'd be a different statement. But if you're building a real company, they don't care about that. They know it's going to take care of itself when you build a real company. So there's some certain investors that probably don't have a clue and don't understand venture, don't understand it takes hard work to build companies. It takes 7, 8 years to build a company, see an exit, but that's what it took. That's what it took in the 60s and the 70s. And for a brief period in the 90s, it was hallelujah. And now it's back to a lot longer time frames. And that's why
Well, we need the longer time frames, absolutely we do.
But I think a lot of this patience is, I mean, if you're a venture fund and you've funded something and you've been in it for 6, 7 years, I mean, we see it day in and day out. There's a sense of urgency to make something happen. So I think, again, it gets back to, venture guys are taking money from limited partners, and they're getting calls and what's going on. And if they're going out to raise another fund, they're looking at their returns. And I do think there's pressure in the market. And I don't think a venture investor is totally numb to that, because I do think there's a lot of pressure you get when you're, you know, depending on the cycle and where you are in the fund. If you're early, you're very patient. If you're late, you may want results depending on how your portfolio performs.
You know, I think there's a nuance here that Roland's underscoring, but that is, you know, you're trying to separate good deals from bad deals, or what's going to be a good return on your investment at the end of the day. And if it's something that's just an ingredient for a bigger solution, or it's just a you know, a piece of a bigger, I'm trying to think of like other examples where it's not the full piece of a stable, you know, company that's standalone. That's the kind of thing that's easy to steer away from. I mean, you're hoping for filling a gap of another company's, you know, roadmap. And that's a higher risk thing, especially in an environment which feels like today is, where there's 2 or 3 or 4 companies, or maybe more, doing similar things. They could also be trying to fill that same gap in the same 5 companies' roadmap. So that's an easy one to steer away from. If you're, I'm more comfortable investing in a company that's going to build a business that is tangible and can stand alone. And if that business, if they're successful and they get acquired in the short term, and it's a decent return, I'll take it. If I gotta wait till they start being cash flow positive and you know, have $100+ million revenue, you know, and I'm returning business cash to my shareholders or limiteds or whoever it is on dividends, hey, that works too. But you know, not to be swayed by the kind of popularity in different segments. And the other thing I think is that we sort of touched on that's a change is in some of these businesses like Craigslist and other consumer internet businesses, there's a different cost of capital, and there are different capital requirements really. And so these companies can start on a lot lower investments. Not all deals are venture capital investment opportunities. Most venture capitalists are looking to put a material amount of money into each deal because they have to invest a material amount of time into each deal, both structuring it and then working with them after that. So, you know, a small investment just doesn't pan out for their time. So sometimes it makes sense to raise angel money. Some venture investors are willing to put less money in a deal. But I mean, there's examples like Dig today. I think they raised $3 million over their whole career. That's not a lot of money. And a lot of venture firms would say, I'm not interested in $3 million or less. Okay. So they wouldn't look at that deal at all.
That's right.
So, you know, you have to look at these things and decide whether you're even looking for venture capital or whether you're, you know, got a different way of financing.
There's always another way to go about capitalizing the business if you can. I tell my clients that profitability covers a lot of sins. So if you can get to the profitability, you can then start to look at the market and what you want to do next. And sometimes you don't want to exit at that point, or sometimes you get surprised. Let's talk about the deal structures. Todd, what kind of deal structures are you doing in your early stage series?
Well, you know, preferred investments, which means that we put our money in and we buy a piece of the company, and that comes with certain preferences, which means we get our money out first, and then there's some things that the company can't do without our permission, and that's very standard. I mean, these days, I've discovered recently that there's East Coast terms and there's West Coast terms.
Oh, let's see.
Because a lawyer that I was negotiating against got flustered and said, well, those are East Coast terms. And I said, dude, I'm in Boston. The company was in New York. Where are you? Oh, I'm in San Mateo. Okay, come over here. We'll, you know, when I put you on the West Coast, we'll let you do the West Coast terms, which I guess are a lot less onerous than our, you know, East Coast terms, where, you know, the first child and stuff like that.
So the moral of the story is take your money from the West Coast?
No.
It's have a big family.
George, can you tell me something about the deal structures you see?
Yeah, well.
And where are you? You're West Coast?
Yeah.
Yeah.
Well, the last 6 deals we did received between $250,000 to $500,000.
Mm-hmm.
We are. My expectation is we will do probably somewhere between 25 to 50 seeds over the next year to 2 years. We do not have pressure from investors to show results. We're showing great results, and the firm's been around for 36 years. So I think we're fortunate to be in that position. So we're just thinking about how can we enter things that can generate a large value, the potential to get to a large value, and how do we sustain the company while getting there. So that what that means in terms of deal structures, we're very comfortable doing seed deals. Our last 6 deals, which we did over the last 3 months, have all been seeds. I'm doing a Series A deal right now, which is closing down here, which is a $1 million deal. Where I'm putting in $1 million of capital. So I think we're an outlier in the venture business. Total funds under management in the entire venture business has gotten so large, and it's pushing people to think of the venture business not as a returns-driven business, but as a money management business.
Okay.
And I think that's the biggest sea change in private equity. There's an entire bubble in private equity globally, and I think that's affecting and distorting people's behaviors.
Let's talk about that a little bit.
I mean, here the easy example is, I mentioned this right before I got started, but we were interviewing a summer associate to join us out of Harvard Business School. And they have
East Coast guy.
Yes, and they have competing offers from hedge funds and LBO groups.
Right.
And their offer is for a starting salary between $300,000 to $600,000 from those entities.
For the intern coming out of
This is a
Harvard
first-year
MBA.
student
Right.
coming up.
Position still open?
We're not paying first-year students at Harvard Business School, but what that indicates is there is a massive bubble on the buyout and hedge fund side, and we're feeling it a bit on the venture side. A lot of this stuff is just an echo of the bubble, the boom bust from 2000. What's happened is money is basically coming from all parts of the world back into the U.S. system, so it's affecting everyone's behavior. I think that's a long-term trend. And the good news actually for us is, by the way, that no longer does venture capital last. It lists as the #1 job you want coming out of Harvard Business School. The #1 job is listed as buyout funds and hedge funds. So, and that usually whenever it lists as the #1 job is usually the year that it peaks.
We're on the downturn already, right?
Probably.
Okay, so don't give up your startup businesses to go to Harvard Business School. You're too late, right? Now, the hedge fund deals aren't very pretty, are they? They're pretty aggressive. They're more aggressive than others. Maybe I should ask David.
I don't know. I'm not in the hedge fund business.
David, do you know?
What was the question?
The hedge, making notes here, right?
I know I do recruiting, and I've actually said this on investment banking, and thank God investment banking is not even in the top 10 anymore. Because I always get nervous when it's #1 as well. What was the question?
The question is about hedge funds, the terms and conditions from hedge fund investors. My understanding is that they're nastier than other offers.
No, they're actually not, and that's what's,
Okay.
I think actually the problem. I mean, let's just step back from an investment bank. Some of the largest fee payers now are private equity funds. And I should say some of them, I think almost across the board. I mean, we're talking $80+ million a year in investment banking fees from these large private equity funds. The hedge funds themselves, and I think it's really broadly defined because there was a time where a hedge fund, they took money and they would hedge a position. Now it's just, I've got a fund, I don't know what the hell I'm going to do, but I'm going to raise money and do a lot of whatever. But as a result, because I've seen this, is there is a real expertise to venture investing. And, you can look at the returns and you can look at the structure and, someone can always be on the wrong side of that, but there is a reason, there's a risk and return trade-off. And if I'm investing in one of the venture funds here, I know that, on average, 1 out of 10 make it, the others fail. And so you need a higher level of return to be in that market. What we're seeing is hedge funds coming in and they're not really putting the amount of assumption of risk in this. So they're looking and saying, gee, if I can get as long as I'm beating the S&P, I'm doing great. And that's a very different structure, but they're coming into these later stage deals where they think they're, oh yeah, it's going to go public or it's going to get sold. And I said there's a lot of work that needs to get done on any of those processes. So if anything, I think they're driving down returns, which makes it good for an issuer in the short term, but I think longer term, it's going to be a challenge for everybody because it's going to all trickle down and it's going to go, all the way through the cycle and it's going to make the returns in venture go down and quite frankly improperly reflect the risk.
Yeah, I would agree with that. I mean, our LPs tell us they view the top quartile of venture to have about 12% annualized returns through the rest of the decade, and the bottom 3 quartiles to have a negative 18% annualized return.
It's just hard when you've also got the very large private equity firms that have so much money to put to work, and they're willing to go in on some of these bigger deals and look for returns in, the mid to high teens, which is a significant difference from, where it was 10 years ago. So it's pressure on all sides of the market.
It almost breaks the model. I mean, when we do private placement analysis, and your typical venture return is, 3x plus, and depending on the stage, and a lot of it just, and also look, it's like, 30% return. I mean, it's not even kind of within the band.
So this is driven by just plain too much capital again, floating around, but now it's from different sources?
It's coming from outside the U.S. After the U.S. currency basically changed in terms of valuation, the rest of the world basically started printing a lot more money. You had a big run-up in foreign markets, and those markets are basically feeding the cash back into the system. It's not the same exact U.S. investors. It's lots of money coming from the rest of the world still entering the system to rebalance their asset allocation mix between public and private. And so as the public markets float up, the private market, people think that, hey, I have to maintain a correct asset allocation strategy. I have to put more money into private, and I've got, the king of Saudi Arabia with his $600 billion fund, maybe we should take some capital. And by the way, that's a real number.
So where are they putting it? Are they giving it? Where are they giving it?
It goes into different entities who do asset allocation for these people that hold lots of capital.
But who's making the choices of where that money gets invested? People who know what they're doing, smart money, or
people who know what they're doing is defined by results, right?
Yeah. Well, but are they giving it to experienced fund managers who do investment in something as complicated as emerging technology?
It's pretty simple. They're portfolio managers, and venture capital is now a viable piece of that portfolio. They're going to put between 2 and 15% of their money every year, no matter what, into venture capital. Sometimes they'll take it up a little. Sometimes they'll take it down. There's a few endowments that are up to 15% again, and there's a few state pension funds that are down to 3%, and there's always going to be money for venture capital. Right now, there happens to be too much. So I don't think anybody should make any more venture capital investments. Nobody should want to be venture capital.
Another destroyed career. Now you can't be a venture capitalist either.
But Joey, there was a recent survey that came out that looked at investing, for the first 9 months of this year, which I think has some interesting stats, which said that VC investors directed $6.4 billion into 611 deals through the end of September, and that $6.4 billion. This is across all industries.
Into 611
deals.
Okay.
And it's basically the first time since 2001 that there have been 3 consecutive quarters in which investments exceeded $6 billion. And if you think about that in the context of over the last 18 months, there have been more than $35 billion raised in new VC funds. Not even counting all the other layers that we're talking about. That's a lot of money that needs to get put to work.
Yeah, I mean, you do the math on the numbers coming into the business. You have to generate a new Google every other year.
And how long does it take to build these companies we're building? Longer than that.
Yeah.
Much longer.
They have inventory on the shelves when good things happen.
Yes.
Absolutely. So it's turned into a boom again because we have too much capital.
Well, the question is who the boom is for.
Well, but I think we're at a very early adoption stage of all the technologies that this conference is about.
Yeah.
We've tripped past the innovators into the early adopters.
Yes.
We're not even beyond the early adoption stage, which means we have years to go before most of the technologies that this group is interested in and that you're looking to invest in, before they're ubiquitous or even past the early majority. So it's a much longer timeline.
You have to understand that there's 2 levels here. One level is new technology comes out, new products and services are available, people use them, in some cases buy them, and that's kind of the way that goes. And then up above that, there's this whole financial thing, which is, you can go public, you can sell, your multiple is this. Look what those guys went for. That's separate. You almost can't pay any attention to that. You don't even look at that. That's like using a stopwatch rather than a calendar to track your companies. You invest in really good people going after ideas that could be big and revolutionary, and you just make sure that their capital requirements are reasonable, and who cares about the rest? It doesn't matter.
And at a really high level, I mean, based from that number, I think on the VC activity this year, media and entertainment was among the top 3 areas of investment. And some other numbers that I kind of came across in September, there were 39 digital media acquisitions done and 36 new venture investments done. And about $350 million invested just in September. So I mean, there's a lot of activity, and it's not totally disproportionate in terms of number of deals or what is happening on the exits versus what's happening on the new investments. And there are these weather type concerns, but I think at a high level, people recognize that this is one of the areas that's emerging and interesting. And the big Google YouTube deal, while I think people are concerned, it does add some validity to this area, and I think maybe even increased sense of urgency about what other people are going to do and where they go to kind of plant their flag.
But even when people focus on the big dollars involved in that deal, as of yesterday, it was a little over 1% of Google's market cap, which is, it's tiny. So
that acquisition was free. They made money on it. They spent less than 1% of their market cap, and I think between then and now, you might argue the day it was announced and the first day the stock started trading, I think the stock was up 3 to 4%. Now, you don't know if they're going to continue that or if it's ever going to have a big impact, but I would say that was a free. So I think people should just get out their checkbook and make all these free acquisitions. We have a couple.
And they didn't have to.
It doesn't matter what you pay if it's free, right?
Yeah, I think a really interesting part of the trend is effectively, I live in the Bay Area, so what's basically happened is we've transferred the market cap from Seattle to the Bay Area, which as a homeowner makes me very happy.
It's expensive in Seattle, too.
Well, we're transferring their value to us by siphoning off Microsoft's cap.
Okay. Next question. What happens when it changes again? Is it going to change again? I mean, generally when you flood the market with this much capital, you get a peak and a trough. Maybe nobody's worried about this, and don't tell me it's a stupid question. It's a real question. Go ahead, Nolan.
That's a great question. It's actually already happened. In spite of what we're saying here, investors this summer, a lot of articles in the Wall Street Journal, a lot of articles in the press, is venture dead, is the model broken, is it over? We just had our annual meeting, that was the big question. You have venture firms trying, let's do all the big Walmart approach to venture capital, naming the firms raising billions of dollars. You have other firms like Charles River actually looking at, okay, let's segment it out, let's work on 25 to 50 companies and see which one kind of gels over time, and let's focus on those ones. And you have approaches in between, but I think you really have to think hard what's going to work going forward as a venture firm to invest, because the capital will dry out now. Okay, these investors will start to diminish in spite of what we're saying. The buyout funds are peaked. Now that's going to take a few more years to work its way through, but I know the heads of Silver Lake and TPG, and these guys don't know what the hell they're going to do, and they'd like to get out of this thing right now. They won't, because it's great. They're at the top of their game. Venture firms are going to start to size down, I think, as smart guys beginning to ratchet that money down. Now, how fast this happens, I'm not sure, but we had a 2-year window here from 05, 06, actually 04, 05. Great for raising money. 06, okay. And I think it's going to get worse and worse again because returns aren't there. But I don't, the macro problem is not going away. And India, China is absorbing a lot of capital. Europe, I think, is difficult to say the least. And it's going to come from foreign places, it's going to flood these other markets as well. The world's very liquid. It's not going away. The world is highly liquid everywhere. Real estate's expensive. I don't know if you look around, but that's a very good indicator that it's going down, sure, in Sacramento and sure in Miami, but the coasts aren't going down at all. And real estate's a good indicator of capital liquidity is still there.
More on this? Come on.
What's the this?
Well, the this was what happens when the capital starts to go away. I mean, yes, we should be investing in, and you should be building companies that have sustainable value and growth preferably lots of profitability, so you've got a lot of freedom.
Well, I'll
That's
throw
true.
something at you that's going to be unpopular and controversial today with Al.
I'll take it.
Let's spice it up a little bit. So the companies that are successful today are basically the blood gorge ticks of the industry. They're the arbitrage. There's the guys that run on other people's infrastructure, either using other people's content and monetizing that, or building eyeballs on other people's infrastructure. And let's take Skype, let's take YouTube. What are these guys doing is they're taking content from other people and they're running it over infrastructure that was built by the Comcast and the AT&Ts and the Verizons over dozens of years, trillions of dollars worth of infrastructure, and they're arbitraging it by saying, I'm going to take it, I'm going to put it there, you're going to come see it, I'm going to charge people for it, and all of that, and you argue, are those real businesses or not? Now, I say that, and I'm a happy supporter of the blood gorge tax, because I think that's a very capital-efficient way to give the consumer what they want, ride on somebody else's infrastructure. Why would I want to build another Comcast so I can deliver 4 meg to somebody's home? And why would I want to go off and build another Disney so I can create content that I can monetize over this infrastructure? That's where the opportunities are right now. It's in that arbitraging. And it's beautiful if you can find one little white spot that somebody hasn't figured out how to arbitrage yet. YouTube's a great example. Skype is a great example. And you're going to see multiple more of these come and go. Are they real businesses? I don't know. The various entry of zilch, and it's just a question of how fast you can get out there and arbitrage. And I can tell you, these arbitrages are despised by the people that whose infrastructure they run on top of, and the people whose content and media that they deliver. But hey, that's capitalism.
But isn't that always the way the early adoption of disruptive technology works? The infrastructure exists, and the little leeches get on it, and the leeches take the risk, whatever it is, to deliver a new marketplace, a new awareness of what can be done in an emerging and disruptive technology, so that the interest moves and people start using it. It's not the 17-year adoption of consumer electronics that we're not used to. There is the 17-year adoption before it's ubiquitous, but that's how the new technologies always begin. They can't afford to build the infrastructure. They're making the noise that makes the market. I'm with you. If you can get the timing right, then it's a fine investment. But then it sets up a business model that holds up or doesn't hold up. Maybe the business model cracks, but it rebuilds itself if it cracks, and then you have the beginning of a real adoption curve and a sustainable business.
Yeah, I guess my only criticism of that approach, that, by the way, is working quite well right now for a bunch of people, is that I think what happens is the arbitrages get acquired by the big companies. That's what's happening right now. Because that arbitrage usually is a temporary thing, and you can't get that economic rent forever, so what happens is other competitors come in, the big guys figure out what they have to do. So there's always this brief and shining moment where you can monetize that arbitrage, and they always are there, they always come and go. The problem is the bigger companies are getting bigger, and the innovation isn't necessarily there, and the smaller companies that are doing the arbitrage aren't existing on their own to continue to build and innovate and all that. So I think what we have here is this kind of short cycle consumption. Like something goes fast, something goes up, down, and overall you wonder, are we really getting the kind of invention and innovation that we had in the past?
Well, but the big guys are buying these companies not because they want a business model or they really care about a business model. What they want is the audience. So for the big media companies, and Google is in many ways a media company because their revenue is driven by advertising. What they need is the audience, and so if they can get a very large-sized audience with cheaper than it would cost them to build it, then for them that's a good deal.
Yeah.
So they don't care about the business model as much.
Yeah, I mean, you just look at market caps, right? Google, $145 billion. Comcast, $100 billion. Viacom, $30 billion. Some of the biggest advertising agencies, $10 to $20 billion. The media empire is being upset. It's happening slowly. People who are smart down here running media empires know that, and you know that from working with them. And there are smart people running these companies. They will get them into shape for this new environment.
Yeah.
Maybe not as quickly as people in Silicon Valley, like myself, like to make fun of them for doing, but they're doing it.
The only thing, though, I would add, I mean, you see, I think a lot of times with M&A, companies get validated and models get validated before they've really had a chance to be proven out. And I also remember when GeoCities was bought, and I don't think Yahoo, I think they wrote it off afterwards. You know, it all goes in cycles, and I definitely, and I think it's a natural thing as markets mature, you get these net consolidators. It's basically outsourced R&D. Again, 95% of all exits in M&A, and part of that is, you know, large companies, it's a lot harder for them to really get ahead of the curve. And quite frankly, they don't have to, right? If I'm, you know, Google obviously is spending a tremendous amount of money, but if I'm Yahoo and where I am, you know, I'm going to be looking internally, but I'm also going to be looking externally for new ideas, and if I can do that, you know, with traffic. But, you know, just on the YouTube thing, I mean, you know, the elephant in the room is a lot of that content is illegal content, and at some point, the faith is that it will be turned into a model because we have all the traffic, and you know, at some point we'll be able to make this thing work. But I think that is a phenomenon that, quite frankly, always happened before as well, and people will tolerate it until you make a lot of money. And if Google was making the kind of money it was off someone else's content, as opposed to on the search, it would be a very different story. And I think it's kind of the challenge that these companies have.
Yeah, and the rumor about the Google YouTube thing was that a bunch of media companies got stock in YouTube the day before the Google deal was done on purpose, to basically stop the infringement lawsuits of the company. So a friend of mine is on the board, and I know that happened, and those media companies made a lot of money very quickly in 24 hours.
But see, I'm not sure, I mean, I just think of the infrastructure on media companies as like just and not with Intel, but strategic investor, if I'm on a venture arm of, you know, large media company, I'm not really driven by trying to generate the returns for investors the way that a venture fund is. It's very easy to look at a venture fund and say, well, you know, fundamentally you're trying to build good businesses, you're trying to make successful companies, and with successful companies, there's successful returns. I think on the media side, there's strategic things. We've seen businesses die because, you know, strategic or inertia hit or strategy change or whatever it is. And I still think when you're a content creator at some point, you know, there's a novelty factor watching the guy headbutt whoever it was in the, you know, off the World Cup, and everybody went to YouTube and watched that. But if YouTube is making $50 million off of that, or the entity, Google, and you know, someone comes in and says, wait, but that's mine. And there's a lot of content creators. Unlike the record labels where it was much more consolidated and it still was a disaster, I think it's a challenge.
But on the other hand, I think it's easy for a strategic VC to take a call from corporate, where corporates decided they can make a quick buck, you know, and make a huge paper profit relative to their own earnings, and turn around and do a deal, and you know, it's really very little skin off of their back.
Yeah, but I mean it's a one quarter charge that it doesn't really impact them, because investors are going to look at what are the operational profits of the company rather than just the investment. I mean, unless they can keep doing it.
Yeah.
What would have been more interesting, would have been if the media companies got together and actually made an investment and said, well, this is going to be, you know, this is going to be a platform. And I know they've tried, it's been a disaster in the past, but that would have been more long-sighted, hey, look, this is coming. And rather than sit and react, rather than, you know, spend billions on legal fees to shut down companies and slow down innovation, let's really try to get behind this because consumers want it. I mean, that's novel, but you know, if they did that, I mean, I think that would have been more interesting than, oh, like, how do we make a quick buck? Because they're going to go back to Intel.
I think that's good. This was sort of a short-term solution, but I do think something that's noteworthy that I've seen coming to this show and investing in this kind of digital home media, consumer internet area over the last 5 years is, you know, there's really been a sea change in the interest from the media companies in playing here in this digital thing. And I think it was just 2 years ago I came to this conference, and you know, it felt like all the media people were just sitting back listening to the tech guys talking up here, or tech people with their arms folded saying, you know, I'll believe it when I see it. And there's sort of discussions happening about, who's most cutting edge and who's a little behind the curve today. So everybody's doing something and talking about what each other are doing. So that's a real opportunity for startups.
Hey, people getting fired for not doing deals, for not getting eyeballs and not and missing out.
Yeah, we've come a long way.
Yeah,
I mean,
that's a big
3 years, I remember doing
Yeah.
this panel 4 times a year for years. 3 years ago, nobody would invest anything in a consumer-based product, right, before 2003.
And then the VCs did it,
They
and
did,
then
right,
but the
and-
media guys were not believing
That's
it,
right.
and then now it's legitimately happening.
Yeah,
So,
it's beginning. It's beginning. They're taking the risk. Okay, let me have each of you say whatever it is you want to say to the audience that we didn't get to, and then we'll open up for questions. You can pass if you want, but start with Todd. You're at the beginning? No, he wants to be last.
No. I don't know, I mean, I just want to emphasize, I don't think I've emphasized it, I want to emphasize that I think the venture capital business is a great business. I think it will continue to be a great business, and I think it's all about, backing really good entrepreneurs going after big ideas, and the rest takes care of itself. And it goes up and it goes down, and there's too much money, and there's too many deals, and and all that stuff. But you know what? It's still, if you can create a few great companies over a 5 to 10 year period, it pays for itself.
Well, I've been here about 24 hours, sat on about 4 panels, in the audience at 4 panels watching. And there's one thing that the last two particularly, one was about music, one was about video and DRM issues. And it was amazing to watch that none of the issues that are brought up are being solved yet. And I dealt in content creation years ago with 3D VRML stuff, which was really hot for a while in the mid-90s, and we made tools so anybody could create content, just like you can do today in video and pictures and whatever. Didn't work. Why? Content creation is really hard. Creative people are hard to find, great writers are hard to find, great actors are hard to find, great musicians are hard to find. Well, music may be different. But talent is hard to come by in creating great content, and therefore there's always a premium for that great content. And what's frustrating to the content creators, in spite of their maybe some efficiencies in their models, whatever, they should be paid for that. The content creators should be paid, and the guys who produce it should be paid. The guys who take the risk, just like they're venture guys. I mean, they invest in great people, right? And just watch this whole, P2P networks flourish and people rip content and kids do it, pisses them off to know when they put all these people out of business. Well, it's still the rage. It's still the rage when all the teenagers and 20-year-olds and 30-year-olds are ripping off everything they can rip off because they assume it's not ripping off. And that might, just like in China, just like in South America, just like in Europe, okay, it's free. And no one understands the solution to this. And all these panels, no matter what they come up with, doesn't understand. And I would really like to understand that more and get into that, because somehow that disconnect between, and the internet does it in some ways, because you have great talent through MySpace or whatever mediums they surface, as an unknown source, become a great talent, and then pop to the front of the stack, okay, which is a hard thing to do, but the internet can allow that to happen. But how do you create a fair model, a model that actually works and it is interesting, okay? So these guys who take the risk on, novel, new talent and get paid for it. And that's as frustrating to me to watch this happen as anything else, and I'm looking for solutions there.
Thank you. George?
Pretty easy for me. Lots of thoughts, which I'm not going to talk about now, but if you want to reach me, I'm george@crv.com.
That was easy. Son?
I just think that this is a really exciting time to be part of the digital media community. And if you're an entrepreneur, to think about the whole content area and creating new forms of content that are well suited for broadband and mobile, because you can't just take the old stuff and try and repurpose it a little bit. But the best innovation's coming in the form of new content, and I think we're just at the very beginning of that.
Mike?
Yeah, I think this is a fun, innovative area. This being kind of the digital entertainment, consumer internet area. And, there's a lot of innovation happening, and so I guess I'm looking for, good, fun people to work with to go take advantage of these opportunities, and I just think there's a lot out there.
Well, just to echo, I think it is an exciting time right now in the industry. And I would just say, particularly if you're an entrepreneur, but you know, this is a cyclical industry. Technology is cyclical. There was a saying that I said before when there was only about 15 people at this conference, and it was, you know, anytime you think there aren't cycles, we're either at the top or the bottom. And, you know, appreciate the ups, and when things are down, just know that, again, it's a cyclical industry. I think if you are building for the long haul, and I think someone mentioned it was, you know, build on a cloudy day, or it was some analogy that someone said, which I think is a great kind of way to look at it, prepare for the worst and hope for the best.
Could you please, before we turn to questions, give your URL and or your email address so people can contact you?
Why don't we just write it on the front of the cards?
Okay, you could put it on the tape, it might be useful. David?
I'll do it. It's david.higley, Higley, @ubs.com.
Mike?
Yeah, mine's just mike.buckley@intel.com.
Good. Son, please?
Sun.young@opco.com.
Thank you.
George@crv.com.
Great. Roland?
Roland@comventures.com.
Todd?
Just go to sparkcapital.com and you'll see it all there.
That's great. Thank you. I'm Joey Tamer. I'm at joeytamer.com and joey@joeytamer.com. And my last comment before we go to questions is, if you're building a business, this is a good time. You should move quickly. You should look out for these adoption curves and make sure that you understand the capital environment that you're in. And let's then open to questions. You need to come up to the microphone. You can line up if you want.
So it's understandable you guys won't comment on what's hot now to invest in, but what's in your existing portfolios now that looks right for liquidity? What segments are those?
One of you can take it.
Well, we have two companies that are ones that, I mean, these are generationally old companies because they're successful now. They're $100 million companies, but ones that Zent has email and document archiving for enterprises, and it's all about retrieval and archival of information, which is really hard to do for enterprises. We built it over 7 years and it's ready to go. And then there's Market Tools, which is online market research, on-demand market research on the internet, and builds panels and, again, older models taken online, and it's again, really sizable and doing great. So those are the ones that are, but again, 6-7-year-old investments.
There's a message in that. You have to build a company that actually works. Other questions? Come up to the microphone, please.
I'm an independent content creator. This is the most interesting panel I've seen here, and I just wanted, but there's just such a big gap between the people who believe that they can build, believe they have an innovative idea, believe they're creative, want to build a sound business, you know, have thought this through very clearly, and I know other people like myself, and you all are just in a completely different world. Yes, well, how do you connect with, how does a creative person or someone with an independent company, an upstart, connect with the business world, even if you have the technology model? How do we just email you?
You gave them the email addresses.
I think George is a good answer for this too.
Yeah, so
The audience wants to know what you create.
What is it you create?
Okay, I'm an independent content creator, and I want to create a narrative serial. I mean, my idea is actually bigger, and I don't want to discuss my entire idea. It's fictional, it's very interactive, and
All right, that's good. Narrative, fictional, original content, interactive for the new media on digital. Okay.
So
They want to know how they come to you.
Basically, I mean, so people across the panel invest at all different stages. Some venture firms invest at very early stages where people just have ideas and, may have very little, business experience. And part of that goal for them is to invest in building a team around them and helping them, if it's a good idea, build the rest of the story that creates into a company. George, I'll sort of hand it to him, but he mentioned, that's the bulk of the deals that they're doing today. So, that's his expertise. Intel, while we lead investment rounds, we don't tend to get involved in companies that are like really early concept stage. But, we like to be involved where there's maybe other institutional investors already there or going to come on board shortly. But,
Yeah, I can understand your frustration. Before I was in the venture business, I raised venture twice, and one time I thought like no one could understand anything we were saying, and there's a good reason because we were telling them, a totally ridiculous story. I think I'm not saying that your story is ridiculous, but the issue is that a lot of times, like an investor you might talk to might not be appropriate for what you're doing, so that's why they don't get it. In that case, you should actually be talking to someone else. I think the biggest.
You come talk to me if you're investing.
I think the biggest issue facing investors, I can give you it's not like I'm just hanging out playing golf and get 5 emails a day. My biggest issue actually is I get about 200 emails a day, 20 to 30 of them are deals, and I'm forced in 30 seconds to make a decision whether I'm going to allocate an hour or 2 hours that week to meet with that person. And I don't have endless resources time-wise, so it forces me to make very quick decisions. And my life is one of being 10 miles wide and an inch deep because I get to see a broad landscape of things, and I don't understand a lot of them. And it's not because they aren't good ideas, it's just my abilities are limited, just like everyone else is on this panel, just like yours is, just like everyone's is. So my suggestion to you is use the web as a resource to find out what kind of investors might be useful to those people. And then really critical is find someone who knows someone there, so you can kind of glide in on their relationship of trust. Yeah. Yeah, because in my busy stack of stuff, I always have people trying to introduce people, and I always answer the people that I know, saying, hey, I really want to introduce you to blah, blah, blah. I have to return their email and pay attention to it because they're friends or people that I respect. So my suggestion is try to find someone that knows someone at one of these firms that you would like.
But there's also a big disconnect, I think, in content creation from what we do. I'll say we, and that's I think what you're alluding to, because frankly, I couldn't judge a creative talent. Okay, my brother's a musician, my father's a composer. I have no clue what that's about. I'm a technologist, and I know how to build some companies. So when I said all the producers down here, they're venture capitalists. They invest in new people and new ideas. They have the same processes that we have when we build our companies, and they might be cumbersome and archaic because they're so institutionalized now, so they're not free thinking. You might be frustrated by them, but they have the process. They know how to find writers to flush out your stuff, or other people. We know how to do that with our kind of companies, and that's the disconnect. So we're not necessarily. When I see content guys come by and say, "This is a great idea. I wish I could help you, but I can't." And some VCs might be more oriented, but I don't think that's institutionalized in Silicon Valley anyway, or in Boston. I think that's down here, and it's a whole different elk. And so I want to be careful of what you're not.
It always has been, I think. I don't think.
Yeah. No, it will continue to be because it's a different mindset.
Let me help with this answer. You're right. You live in two different worlds, the creatives and the money guys. And if you're going to be a creative and you want the money guys to give you money, then you have to create a business they can understand, speak to them in the language that they understand, and talk about what they understand, which is about management, it's about return on investment, it's about building a sustainable business model that creates profitability. You may not care about that, but if you want outside money, then you have to get somebody to train you how to look at the world that way, package your idea that way, and then have it in a deliverable form, which is very short. It's always harder to write it in 3 pages than in 30 pages. But if you put a 30-page pitch piece together about your business that talks to the investor the way the investor wants to understand it, then you can get somebody to pay attention to it as a first bite, and then you get to go deeper. Doesn't mean you can do anything short of all of the planning of how the business will work, but then you've got to put it in a type form that 30 seconds of attention allows for you to pitch about the stuff that they care about. So it is a cultural gap that you have to cross if you're looking for the money.
And then just find a way to get it.
That's right. And then you network and you find somebody who can get you there, right? Okay, one more question, then we have.
Hi, John French with Digital Media Alliance Florida, Florida's Digital Media Industry Association. And one of the things that has fluctuated along with the availability of capital and the approach that the VCs and other investors have been taking has been the form and format and content that you are emphasizing in what you see as your quick 30-second brief. Has that changed significantly now? You talk about building long-term businesses, significant strength, et cetera. Does what you want to hear in the elevator pitch and what you want to see on the first 3 pages and what you want to see in the 30-page overview change, or is it basically the same thing it's been in the past?
For me, it's the same thing it's been in the past. You know, tell me the problem or a new opportunity you're creating and how you're doing it in an unfair way. I want someone who's got an unfair edge. Because unfair edges basically create gross margin, and gross margin creates cash flow, and people value companies based on cash flow. That's why there has to be an unfair edge. If it's, you know, if there is no unfair edge, then there's no margin, and then it's not a good candidate for a venture investor.
And you need to lead with that. Okay. Thank you. Let's thank the panel. Panel, please.